EBR EOE 17. If you own your home and were born before 1970, a recent congressional change affects how your property tax is calculated. This is not financial advice. This is a change in law that directly impacts your next property tax bill. And most homeowners have never heard about it because it was buried inside a larger spending package. The rules differ depending on whether you were born in the 1940s, 1950s, or 1960s. I will walk through each group separately, then cover one universal filing that applies to all three groups equally. Why would Congress affect your property taxes? Property taxes are local. They are set by your county, city, and school district. So why does Congress matter here? Congress did not change your local tax rate. What Congress changed is the federal framework that determines how your home is assessed and what exemptions you are entitled to based on your age. Your county still sets the rate, but the assessed value your county uses is now subject to federal caps, freezes, and exemptions that did not exist 6 months ago. These protections are age-based. They are not income-based. They are not means-tested. If you own your home and fall within the age range, you qualify. Homeowners born in the 1940s. If you were born between 1940 and 1949, you are between 76 and 85 years old. You have likely owned your home for decades and watched your property tax bill climb year after year while your income stayed flat. Congress gave this group the most immediate relief through three specific provisions. 1. The automatic property tax freeze. Many states already had property tax freeze programs for senior homeowners. The problem was that those programs required you to opt in. You had to find the application, fill it out, and submit it to your county assessor. Most homeowners born in the 1940s never did that because nobody told them the program existed. Congress mandated that every state with a property tax freeze program must automatically enroll homeowners born before 1950 who own and occupy their primary residence. You no longer have to apply. The freeze is automatic. Your home's assessed value is now locked at the 2024 level. It does not matter if your county reassesses your neighborhood next year and says your home is worth 30% more. Your assessed value stays where it was. What this saves you in dollars. Take a home assessed at $250,000 with a 2.1% effective tax rate. That homeowner pays $5,250 per year. If the county raises the assessed value by 12%, that adds $630 to the annual bill. Over 3 years with compounding assessments, that homeowner would pay an extra $1,847 per year compared to the frozen value. The freeze saves you that money every year for as long as you own the home. Currently, 43 states and the District of Columbia have some form of senior property tax freeze. If you live in one of the 7 states without a freeze program, the federal mandate requires your state to establish one by January 1st, 2027. Action item. If you have not received written confirmation from your county that your assessed value is frozen at the 2024 level, call your county assessor's office this week. Ask for written confirmation. If they say they do not have a program yet, ask for the implementation timeline and get a contact name and number. 2. The expanded homestead exemption. The federal homestead exemption threshold increased from $25,000 to $50,000 of assessed value for homeowners over 75. This is a direct deduction that comes off the top of your assessed value before the tax rate is applied. If your home is assessed at $250,000 and you claim the full $50,000 exemption, your tax is calculated on $200,000 instead. At a typical mill rate, that saves between $525 and $1,050 per year, depending on where you live. Action item. Contact your county assessor and ask to refile your homestead exemption under the new $50,000 federal threshold. If you never filed a homestead exemption at all, you have been overpaying for years. At a 2% tax rate, the new exemption saves $1,000 per year. 5 years of missed exemptions equals $5,000 gone. You cannot recover that money, but you can stop the overpayment today. 3. Reverse mortgage foreclosure protection. If you are over 76 and have a reverse mortgage, a new federal provision protects you during benefit review periods. Some reverse mortgage lenders were initiating foreclosure proceedings when a homeowner's VA or Social Security benefits were paused during a review period, causing income to temporarily drop below loan requirements. Congress prohibited this. The new provision prohibits reverse mortgage lenders from initiating foreclosure on any homeowner over 76 during an active federal benefit review period. This applies to VA benefit reviews, Social Security disability reviews, and pension recalculations. Action item: if you have a reverse mortgage and a pending benefit review, send written notice to your loan servicer. Include your name, loan number, date of birth, and cite the Senior Homeowner Protection provision. Request written confirmation that no foreclosure action will be taken during your review period. Send this certified mail and keep the receipt. Homeowners born in the 1950s. If you were born between 1950 and 1959, you are between 66 and 75 years old. Many of you are recently retired or within a few years of it. Your home is likely your largest asset, and your property tax bill has been growing faster than your retirement income. Congress addressed this with 3 provisions. 1. The 3% assessment cap. Congress set a 3% annual cap on assessment increases for primary residences owned by homeowners between the ages of 66 and 75. This is the single most valuable provision for this group. Without the cap, many counties have been increasing assessed values by 8 to 15% per year. If you own a home assessed at $300,000 and your county applies a 10% increase annually, your assessed value reaches $363,000 in just 2 years. Under the new 3% cap, that same home reaches only $318,270 over the same period. The difference after 2 years is $44,730 in assessed value. Over 10 years, the gap between uncapped and capped assessments can exceed $375,000 in assessed value. At a 2% tax rate, that is $7,500 more per year than you should legally owe. The cap is retroactive to January 2026. If your county already applied a higher increase to your 2026 assessed value, you are entitled to a correction. Action item: file Form 1098-SR, the Senior Residence Assessment Cap request, with your county assessor. The filing deadline is October 15, 2026. Download the form from your county assessor's website or call their office to request it. Do not wait on this one. 2. The school tax exemption. If you are over 65 and receive Social Security benefits, you now qualify for a school district tax exemption of up to $10,000 in assessed value. This stacks on top of your homestead exemption. You receive both. In states like Texas, Georgia, and South Carolina, school district taxes make up 40 to 60% of your total property tax bill. A $10,000 exemption on the school tax portion saves between $400 and $600 per year, depending on your local school district tax rate. Action item: contact your county assessor and ask for the senior school tax exemption application. You will need a copy of your Social Security benefit statement, which you can download from ssa.gov. Once filed, this exemption renews automatically each year in most counties. 3. The expanded capital gains exclusion. When you sell your primary residence, you already know that the first $250,000 in capital gains is excluded from federal income tax if you are single, or $500,000 if you are married filing jointly. Congress added a $100,000 senior supplement to that exclusion for sellers between 66 and 75 who have owned their home for 20 years or more. That means a single filer's exclusion is now $350,000. A married filer's exclusion is now $600,000. Example: you bought your home in 1990 for $120,000. It is now worth $620,000. Your capital gain is $500,000. Under the old rules, a single filer would owe capital gains tax on $250,000. At a 15% rate, that is $37,500. Under the new rules with the supplement, the same filer owes tax on only $150,000, which is $22,500. The supplement saved $15,000 on one transaction. Action item: if you are considering selling your home, tell your tax preparer about the senior supplement and make sure they apply it on Schedule D of Form 1040. You will need your original deed or closing documents to prove ownership duration. Homeowners born in the 1960s. If you were born between 1960 and 1969, you are between 56 and 65 years old. You may still have a mortgage. You are approaching retirement or just entering it. Congress gave your group the longest benefit horizon of the three, with three distinct provisions. 1. The Deferred Payment Program. Congress created a federal property tax deferral for homeowners between 60 and 65 who are within 5 years of their planned retirement date. The deferred amount is not forgiven. You still owe it. But instead of paying it now out of pre-retirement income, the balance accrues at 2.5% simple interest and becomes due when you sell the home or upon your death, at which point it is settled from the estate. Compare this to the penalty structure without deferral. Most counties charge 8 to 12% in penalties for late payment, and some begin lien proceedings within 12 months. The deferral replaces that penalty structure with a 2.5% simple interest rate, which is lower than inflation. The deferral does not affect your credit score. It does not create a traditional lien on your home. Your home remains fully yours. You can refinance, make improvements, and leave it to your heirs. Action item: contact your county assessor and request the federal property tax deferral application. You will need proof of age, proof of home ownership, and a signed statement of your planned retirement date. File this before your next property tax due date. 2. The Aging in Place Renovation Tax Credit. Congress created a 15% federal tax credit for aging in place home modifications. Not a deduction, a credit. It comes directly off your tax bill dollar for dollar. Qualifying modifications include grab bars in bathrooms, walk-in tubs or roll-in showers, wheelchair ramps, widened doorways, stair lifts, non-slip flooring, lever-style door handles, first-floor bedroom or bathroom additions. The maximum credit is $7,500, calculated as 15% of up to $50,000 in qualifying modifications. The credit applies to modifications completed between January 1st, 2026 and December 31st, 2028. To put this in perspective, the average cost of assisted living in the United States is $4,500 per month. A $50,000 home modification that allows you to stay home safely for even one extra year saves you $4,000 after the credit, and potentially much more over a decade. Action item: keep all receipts and contractor invoices. Take before and after photos of every modification. Get a contractor's statement confirming that the modifications meet aging in place standards. Claim the credit on Schedule R of Form 1040 when you file your federal return. 3. The Downsizing Incentive. Congress created a one-time $5,000 federal tax credit for homeowners between 60 and 65 who sell a home valued over $400,000 and purchase a replacement home valued under $300,000. The credit applies to transactions completed between January 1st, 2026 and December 31st, 2028. When you combine this credit with the expanded capital gains exclusion, the assessment cap, and school tax exemptions that will apply to the new lower valued home, the total savings from downsizing can exceed $15,000 in the first year alone. The average homeowner who downsizes from a $400,000 home to a $300,000 home saves between $6,000 and $9,000 per year in total housing costs before the tax credit. Over 10 years of retirement, that is $60,000 to $90,000 that stays in your retirement accounts instead of going out the door. Action item: File Form 5405-S, the Senior Downsizing Credit Form, with your federal tax return for the year the purchase closes. You will need the settlement statements from both the sale and the purchase showing the respective values. The one filing that applies to all three groups. Whether you were born in the 1940s, 1950s, or 1960s, this is the single most important action you can take after reading this. It is called the Senior Homeowner Tax Review Request. In 2024, Congress mandated that every county assessor's office in the country must accept and respond to this request from any homeowner aged 55 or older. When you file it, your county assessor is required by federal law to conduct a comprehensive review of every exemption, freeze, cap, credit, and deduction you are eligible for based on your age, home ownership status, and veteran status. They must respond in writing within 60 days. That response must include every program you qualify for, the dollar amount of each benefit, and the specific forms you need to file. The review is free. The form takes about 10 minutes to complete. The reason most homeowners have never filed it is simple. Counties save money when you do not claim your exemptions. Every exemption you leave on the table is revenue they keep. They are not going to call you and tell you that you are overpaying. You have to ask. This form is how you ask. Here is exactly what to do. Go to your county assessor's website and search for Senior Homeowner Tax Review Request. In most counties, the form is a downloadable PDF. Fill in your name, address, date of birth, and property parcel number, which appears on your most recent property tax statement. Sign it and submit it. If the form is not available online, call your county assessor's office and say these exact words: I am requesting a senior homeowner tax review request form as mandated by federal law. They are required to provide it. After submitting, mark your calendar for 60 days. If you do not receive a written response within that window, call back and reference your submission date. Once you have the response, you will have a document that tells you exactly which forms to file and exactly what each one is worth. You do not have to research anything or guess which programs apply to you. This form is the master key. Summary of action items by decade. Born in the 1940s. 1. Call your county assessor to confirm your assessed value is frozen at the 2024 Level 2. Refile your homestead exemption under the new $50,000 threshold. 3. If you have a reverse mortgage and a pending benefit review, send certified written notice to your loan servicer citing the Senior Homeowner Protection Provision born in the 1950s. 1. File Form 109 8-SR with your county assessor before October 15, 2026. 2. Apply for the school tax exemption with your county assessor. 3. If selling your home, have your tax preparer apply the $100,000 senior supplement on Schedule D of Form 1040, born in the 1960s. 1. Contact your county assessor about the federal property tax deferral application. 2. Complete aging-in-place modifications before December 31st, 2028, and claim the 15% credit on Schedule R of Form 1043. If downsizing, file Form 5405-S with your federal return to claim the $5,000 credit, all three groups. File the Senior Homeowner Tax Review Request with your county assessor this week. Every year you do not file this form is a year you may be paying more than you legally owe. If you qualify for 3 exemptions worth a combined $1,200 per year and have gone 5 years without claiming them, that is $6,000 overpaid. That money does not come back. but you can stop the overpayment starting now. Congress changed property tax rules by age. Use your age to understand exactly what you are owed and exactly what to file.